grass now, keep changing something like that.
Right. That's how I thought.
Yeah, there's nothing left.
Good morning, and we'll call the meeting to order. And I'd ask everybody to put their cell phones on buzz.
I never turned mine
And we'll
on.
we'll call the roll.
Mr. Vickery?
Present.
Mr. Olthoff? Ms. Barber? Mr. Bosser?
Here.
Ms. Campbell? Mr. Kolecki? Mr. Lejeff?
Here.
Mr. Lear?
Present.
Mr. Scholl?
Present.
Mr. Stockman?
Present.
Mr. Washington?
Present.
Ms. Wilson? Present. Mr. Cruz? Mr. Rickman?
Forum present. Public comment, Helen Evers.
Thanks.
Evers.
Helen Evers. Is this on?
Yep.
Great. Thanks. I'd like to know what's going on with the delegation agreement. Never hear anything since it kind of died and fizzled. Pretty interested in that. Whatever happened to the solid waste plan that Donna Sheehan meticulously put together before she got the boot? As I recall, our state's attorney then, he was going to handle it, and I've not heard anything about that as well.
Step a little closer now.
Okay.
Thank you. Is it on?
And I'd like to know, who do I call to ensure an investigation of possible infractions on the environment, especially on late Fridays and or over the weekends? And my last comment is, how could county officials vote themselves a pay raise when it's been stated we can't afford an environmental inspector to protect the health and welfare of the people of this county? Thanks.
Thank you. Look for a motion to approve the minutes of the March 27th meeting. Motion by Mr. Washington, second by Mr. Stauffenberg. All in favor signify by saying aye.
Aye.
All opposed, like same. Motion carries. County Auditor, Debbie Woodruff.
Good morning. All right. My numbers should be correct this month. I had Stephanie check them for me. So if they're wrong, it's her fault. Thanks, Steph. You're welcome.
That's reassuring.
All right. Highway claims for the month of April 2008. Highway fund, $63,953.03. Highway other funds, $801,188.64, for a total of $865,141.67.
Motion by Mr. Lear to pay, and Mr. Washington with a second. Roll call vote.
Mr. Bosser. Mr. Lejeff.
Aye.
Mr. Lear. Mr. Scholl.
Aye.
Mr. Stauffenberg.
Aye.
Mr. Washington.
Aye.
Ms. Wilson.
Aye.
Mr. Vickery.
Aye.
Alrighty. General fund, $2,704,975.16. Special funds, $4,214,798.35, for a total of $6,919,773.51.
Mr. Scholl with the motion and Mr. Stauffenberg with the second. Roll call vote.
Mr. Bosser.
Aye.
Mr. Lejeff.
Aye.
Mr. Lear. Mr. Scholl. Mr. Stauffenberg.
Aye.
Mr. Washington.
Aye.
Ms. Wilson.
Aye.
Mr. Vickery.
Aye. Motion carries.
And County Board payroll for February 14th through March 11th, 2008. Total meetings attended 108. Per diem $6,912. Mileage $703.74 for a total of $7,615.74.
Motion by Mr. Bossert, second by Mr. Scholl. Roll call.
Mr. Bosser.
Aye.
Mr. Lejeff.
Aye.
Mr. Lear.
Aye.
Mr. Stauffenberg.
Aye.
Mr. Washington.
Aye.
Ms. Wilson.
Aye.
Mr. Vickery.
Aye. Motion carries.
Thank you.
Thank you, Deb. As you know, we're doing some investigation on insurance, and today we have a self-insurance presentation, and I believe it's Mr. Shear. Come forward. Yes.
You got that, Joe?
Good morning.
Good morning.
What's this?
Morning, thanks for having me.
You be quiet, Leo.
Again, my name is Bruce Shear. I'm with Homestar Insurance Services. I've been an insurance agent for 11 years, and my focus is group health benefits. Currently, your group health plan is a fully insured health plan with no broker. Two things that kind of raise concerns to me is, one, not having a broker I think would help you to get you better options other than being fully insured. Before I get too involved in the self-funded, I do want to talk a little bit about us and our services. I did give you a proposal. If you flip to your first page of About Us, that first page where it says the Homestar Advantage, it's a description of what we offer as an agency. Again, my primarily focus is on group health benefits. We provide fully insured health plans and self-funded health plans. The majority of the community in our area is fully insured primarily for one reason. When you talk to a TPA, which is a third-party administrator who handles self-funded cases, they want groups at a minimum size of 150 employees. The majority of our businesses here locally are under 100 employees. Certainly, the county qualifies to at least look at being self-funded because you are over the 150 marker. Quickly, I'd like to jump to the services tab. This is what we offer as an agency to our clients. Quarterly meetings in which I would come to meet with a committee to discuss the health plan. We offer local customer service. What I mean by that is if the individual had claim issues, they would contact us. If they did not want to contact personal care, who is your fully insured carrier right now, they would contact us. And we would take on day-to-day issues and claim issues that your employees may have. We would also do new hire and enrollment meetings. We would do educational meetings, which is very important, to explain the plan to the employees if there are any changes, and specifically explain your wellness benefit that you currently have. Whether you know this or not, this is your wellness benefit right here from personal care. According to personal care, a very, very small percentage of your employees use this wellness program. If you are using your wellness program, you are becoming healthy individuals, which is going to reduce your claims in the long run. This is your wellness program. This is available to every single insured that's on the county's health plan. A percentage that they gave me, personal care, less than 5% of your employees are using the wellness program. Very, very small number. If you had a broker, you would be able to have that person go around and educate these employees why it's beneficial to use a wellness program. That's part of the educational meetings that we would set up with the employees or with a committee to spread that word. COBRA assistance is always an issue when an employee leaves. They're always eligible for COBRA. 18 months, we would administer that for you. And we always put a market comparison together for you and compare your current plan to the market that is out there. Okay. The tab that says savings, I put together for you because I think it's very interesting that you take advantage of flexible spending plans. I don't know if the county even has a flexible spending plan. They do. So that is one benefit to try and save on medical expenses. Very interesting. Number 2, question your statements. 9 out of 10 medical bills contain errors. To the individual who doesn't know that, they're just paying bills because that's what they receive. 9 out of 10 contain errors based on a study. 75% of the post-service health insurance coverage appeals are won. What does that mean? You would call us, we would appeal that claim that's not getting paid correctly. 75% of the time we're winning, which saves your employees money. Take advantage of free health screenings, have regular checkups, employer contributions. And I don't know the contribution the county has towards family coverage. I just want to throw this idea at you guys. If you have dependent coverage, meaning you're contributing towards family premium, and let's put the marker at 10%. The employee has to pay 10% of the cost of their family premium, okay? If that employee has a spouse who is working full-time and has eligible benefits, it is my opinion that you make that person pay additional, meaning let's say 25% if they continue to remain on the county's health plan. So, let me back up. If you have a family or an employee that has family coverage, and currently their percentage out of their pocket is 10%, but their wife or their spouse has coverage elsewhere, and they waive off of that plan to remain on the county's plan, I would charge that individual a little bit more for coming onto this plan, because they have eligible coverage through their employer, through their spouse's employer. Something to think about. It makes the employee think about that. It makes them go back to their spouse's employer and ask, how much would it be for me to be on this plan? And again, I don't know your contribution towards family coverage, but that is one tool that we are really stressing to an employer to help reduce some of these costs. We find out a lot that the spouse just waives coverage because this is the better plan and it's cheaper. Well, if we put two categories together where we're making them think about, okay, where should we be? Then they got to make a decision based on their own financial expenses. Okay. The tab carriers. This is who we represent. The health insurance carriers in the top part of the page are your fully insured carriers. The TPAs, those are your third-party administrators. Those are your self-funded people that we deal with. Sage Technology, BSSI, Blue Cross, and Personal Care offers a self-funded health plan. Whether you knew that or not, they do offer a self-funded health plan. Ancillary carriers would be your dental, life, disability, and vision carriers. Okay. Your staff, you don't have to look at the staff of the reference page, but I do have a reference page for you to look at on your own. Self-funded health plans. What you basically need to know is flexibility. You can create your own benefits for your employees. You can add and take away benefits and create your own health plan. When you talk about self-funded health plans versus fully insured health plans, That is the main difference, the flexibility that you have comparing the two. A group this size certainly should at least look at the idea of going self-funded. Why? Because of flexibility. You can manage your own claims by looking at what is going on internally in the group. Where are we experiencing heavy claim dollars? Okay, by doing that, then if you review that, you can make adjustments to your plan and say, okay, instead of having a $10 copay for generic drugs, maybe we change it to 15. Or maybe we don't have a drug card copay at all. I have a self-funded group that does not have a RX copay, and the TPA has told them it is better this way versus giving their employees an RX copay. It's saving the district money by doing this, by eliminating the RX copay. They have a smaller deductible for those employees, but they do not have an RX copay. Those are things that you could look at when you do self-funded plans. Fully insured plans, you're a little bit more restricted to changing benefits. Our TPAs, especially Sage Technologies, is probably the one that I would prefer to work with and get the county a quote and compare it to personal care's fully insured plan. What they would certainly ask for is 2 years of experience, and the person that handles the benefits now, I would just have to be in communication with them to get that plan or that quote for you guys. Certainly a option to think about. I think it's a good fit for the county. I don't know any of your experience. I'm just going based on your group size and what self-funded plans can offer you. Could you stay fully insured and switch carriers? Absolutely. Could you just hire a broker to be your personal care agent? Absolutely. We recognize where we are contracted with personal care as well. We could also go back to personal care and ask them for a self-funded quote and get an idea of what they would have to offer. Any questions about, yeah, Jim?
Mr. Stopford.
Give us a little synopsis of the advantages versus the disadvantages. I think as a board, we're not real familiar how self-funding works. And I know some board members have been in the past apprehensive about going self-funded because it's got the tone to it that we're at risk on everything when we're really not. So kind of give us a synopsis of how that works. And if it's...
Essentially, when you talk about self-funded plans for the employer, you are your own insurance company, meaning you're managing your own claims. You're paying dollars, you're paying your claims up to a certain dollar amount, and then your reinsurance company would come in and pay the rest after that. Fully insured, you're guaranteed, you're locked in at $2 million a year or whatever the premium is, $4 million a year, and then that's that. Self-funded, you may have a premium, annualized premium of $2 million, and if you go above that in claims, then the reinsurance company comes in and pays on the rest, and then it's going to reflect at renewal time. The goal behind the self-funded is to have good years to build up your reserves. So if you did have a bad year and your reinsurance company came back with an increase of X percent, you would have the reserve set aside to take on that increase. That's the key. Don't get in the self-funded health plan 1 year and get out. It's a long-term commitment, in my opinion. You want to be committed to the self-funded idea of, hey, we're in this for a while so we can build up reserves to pay for these claims.
If we, so would we have a choice of where our stop loss would be? Let's say we want to
Yep.
buy a reinsurance plan that stops all our losses at 50,000, or we can pick 100,000, or we can pick whatever we want.
That's the flexibility. Yes, you could put your stop loss at 25,000, 50,000. You literally have the flexibility to define where you want to put your stop loss.
And
Stop loss meaning the individual Each has a stop loss that you pay for.
Yeah, it's individual coverage.
Right.
50,000 or 25.
And I think, too, because we have so many union contracts, we have to match pretty much, don't we, from union to union. Self-funding would give us the flexibility to make the plan the same for everybody.
That's correct.
I think personal care came here one time and told us our RX stuff was 3 times higher than the normal use of RX. So that's a good point that he brought up about that we could make our RX copay $25, $50, whatever, I don't even know what it is now because I'm not on the plan, but raise it to kind of avoid the excess usage that we're getting right now.
Typically, your RX claim dollars is either 1 or 2 when it costs, when we talk about expenses. The district that I was telling you about, it's number 5 on their claims experience, meaning it's the 5th highest cost now. If you're talking about fully insured plans, it's usually 1 or 2. Next to probably office visit copays, but RX copay is generally the big dollar that's causing the claims to go up.
Mr. McCarty.
I had a question on the cash reserve levels. Is there a rule of thumb as far as a percentage of your fully insured plan that you would need to have before you started this? Is there any guidelines or industry standards or that we'd have to hit first?
No, you would not. Nope, we would get a quote, and it's going to define the premium that you were going to pay each month. And at the end of the year, if you did not exceed your maximum liability, you essentially won, and you build up your reserves. But there is no minimum.
Can them reserves be used for anything else, or you wouldn't recommend that, obviously?
Right, no. I would use it for that. For example, to go back to this district, this school district, they've been self-funded for 15 years. They finally had a bad year. However, during those 15 years, they were able to take on that increase because they had reserves set aside. And even with that increase, they were still able to keep their health plan the same. Our job was to look at different reinsurance companies for them. And that's exactly what they did. They changed their reinsurance company. Okay. But their benefits remain the same.
What's the biggest negative?
Year 1, if you lose, any insurance plan is a risk, just like your fully insured plan. If you're accepting 17% increases because of your loss ratio, because your claim dollars are high, that could happen to you on the self-funded arena. You have to be aware of that year 1 if you say, okay, we're going to go self-funded. You might have a bad year right off the bat. But year 2, year 3, year 4, possibly year 5, you may have good years. It's always about the increases that you receive, whether you're self-funded or fully insured. That's the downfall. That's the negative. So we try and manage that for you guys to show you as many options out there from different TP or different reinsurance companies or fully insured companies. Can I be in a self-insurance plan 1 year and then hop back into fully insured? Absolutely. Can I be in a self-funded health plan with this specific TPA or reinsurance company 1 year and change it year 2? Absolutely. The risk and the downside is always the premium rise. And that's driven by your claims. I feel the more educated your employees get about wellness programs and about looking at the benefits that are costing you the most, could help save the county when it comes to premium dollars.
The numbers that, yes, Mr. Lynn.
Thank you, Mr. Chairman. You just mentioned wellness programs. Do you have any experience to suggest what kind of change or increase in participation we might have in wellness with the educational programs you referred to?
Well, I think the key is education. To meet with employees as groups, as individuals, to educate them about this. It is so simple just to get on their website and create your own wellness program. And it takes maybe 15 minutes to do that. From there, you're managing your own wellness program, or you have your representative from your insurance company, which I've talked to them, and they said, we would be happy to come out as many times as possible to meet with the employees to educate them on the incentives of the wellness program. Incentives would be the smoking program that's available to them. If you are utilizing the wellness program, you get rewarded. Maybe you win an iPod by getting certain points towards your wellness program. They do offer gifts to the employees that are utilizing their wellness program. It is probably the biggest topic that we talk about in the field, but it's the most frustrating topic because the majority of the employees aren't utilizing the wellness program. You know, whether we're creatures of habit and we just don't want to break it, I don't know, but we just don't see a lot of participation, but boy, we're trying to get them to change that.
Yes, Mr. Pilecki.
I just had a question. I had a question. I have a little bit of experience with this in the past. We're looking, the company I work for is looking at going to a high deductible health plan with an employer matching with HSA. But we found that had a significant savings over at self-insurance or either, the full-service insurance company. What is your experience with that?
Well, the health savings account plans is a fully insured plan in the sense that you are still fully insured. The key, and I think you already mentioned, is that your employer is helping you fund your health savings account. Don't confuse health savings account as a health plan. It's not. It's a funding mechanism to pay for your medical claims. Because in a health savings account, you get rid of office visit copays and drug card copays. All claims go towards that high deductible health plan. Okay? So you're either telling the employees, we dropped 2 benefits, but we're helping you fund this high deductible health plan. And the health savings account is money you put into this account to help fund your claims, your own personal claims. It's also there to help fund for your dental if you don't have dental coverage, or if you don't have vision, you can use it for your vision. Any qualified medical expenditure, health savings account can be used. If you talk about fully insured plans and self-funded, or self-funded plans, you could put a PPO here and a health savings account right next to it. In a group your size, you could have 3 different plans if you wanted to. You could have a PPO, HMO, and a HSA plan. But the key behind the HSA is the premium lower, quite a bit lower than your fully insured premium. Have you looked into that? Have you looked at the HSAs for the county to compare it to the fully insured plan? If it's only 10% less, I wouldn't do it. If it's 25 to 30% less than what you're paying, I would certainly use it as an option. It takes a lot of education to the employee to explain the plan to them. Because again, you're you're just eliminating 2 key benefits that they're used to having. Office visit copays, drug card copays. Everything becomes first ballot on an HSA plan. Because now you're at a high deductible health plan. Hope that answered your question.
Yes, it did. Thank you.
Any other questions? Yeah, Jim. Mr. Stoffer.
What are you seeing in the marketplace? I mean, I think all of us read that Kankakee City went from personal care to Aetna. And me being in the insurance business, but not in the health side of it, I see rates have gone down in commercial and so forth. Are there companies out there that are buying for business right now that might want to jump in one year and then hit you with a 40% rate increase the next year? I had heard that rumor with Aetna, and I just was curious if that's the case. Are they out there just buying business for now, or buying members and look out next year, or can you get a 2-year contract? We one time had a 3-year contract and we loved it. Is that possible again anymore?
Sure. Well, your current carrier offers that. You couldn't get that now with personal care. buying business is a common practice when you talk about insurance companies. They will certainly, if they want your account, they will buy it. That doesn't mean they're going to win, and you're going to be getting a 10% increase year 2. Certainly they are known to buy plans. For example, any information you provide to an insurance company, especially a group this size, they're looking at your claims reports. They're looking at the activity of what's going on. If they come in 30% lower than what you're currently paying, and the rest of the market is 29% higher than what they are quoting you, they're buying the business. So buyer beware. To an employer, they say, I'll take that risk. Because if I can save 30% for 1 year, I'm going to do it. Maybe the city is doing that, I don't know. Maybe Kankakee School District moved away from, I think it was personal care to Unicare. You know, did Unicare come in and buy some business? I don't know the numbers. But generally, if you've been with a carrier for 3 to 5 years, someone is bound to be competitive with their rate. What I mean by that, someone's going to buy your business after about 3 years of you being with that insurance company. It's common practice. It's unfortunate. Here's when you see them buy it. At the end of the year and about every quarter. Because they want their books to look good.
Personally, I went through a cycle on that with MetLife when I was selling group insurance, so I understand that buy business thing. So, Mr. Bosco.
I think I've related the story before, but I'll say it again. Been involved in a couple of self-insurance pools in the past. Both ended badly. One was our school district out west here. Was involved in a big deal group, Southern Illinois insurance pool. Went along for years, had a nice reserve, things were flying high, and I don't know, the board or whatever got conservative about premiums, and suddenly the reserve disappeared. And so might point up the evidence that a board or a body has to have the political will to leave the reserves alone and not view it as a cushion to cut back on premiums or whatever they charge themselves.
Sure.
So that leaves me with some caution here that as an elected group, it's awfully hard sometimes to make that decision.
It's certainly
leave that money alone.
It's certainly not the answer to the health insurance problems that every business owner is having. It's an option that I think you should look at. It's an option to look at going self-funded. I think it's an option that you look at fully insured companies other than personal care. Whether this is true or not, I've had Blue Cross and other insurance companies just tell me it's hard to get information to get you a competitive quote. You know, Blue Cross has told me, I had a conversation the other day, they would love to write the county's business. But they need the correct information in order to get you a competitive quote. Sometimes that information is available to the person that's doing it now. Sometimes it may not be. You may need a broker to do that. The self-funded arena is certainly good if it's working. It's like any health plan. It's great if it's working. It's bad if it's not. But it's certainly an option I think the county should look at.
Mr. Stauffenberg.
I don't know if everybody here knows or not, but the reason we don't have a broker is probably mainly because of me, because I thought the broker we had was kind of stirring us in the wrong direction 5-6 years ago. And I think some others would agree with me. It's probably time to think about a broker again. I think there are some advantages to us to do that.
Yeah.
Carl and I met per Jim's request when we are talking about the cost to the county for health insurance, and we decided to bring in 3 different people. We'll have 2 more coming in to kind of give us their synopsis of what could help the county out to control these costs, because this is one of our biggest expenses. I'm sure it's what, $4 million now or something like that. Is that right, Steve?
Yeah.
Yeah, so that's what we're attempting to do, is to get 3 of the local people in that do group health and give us some ideas of how we could better control our costs, and then we'll make a decision somewhere down the line. Carl's not here today, he's probably planting corn, because he told me that he might not be here today.
That's what we figured.
Mr. Schultz.
Thank you, Mr. Chairman. Going back to this family coverage, family contribution issue, is this something that you're seeing not only in this type of program, but in various other programs, where if a policy is offered, that individual would be required to pay a higher premium?
This is what I'm promoting, because it's working for a client of mine very, very well. They are making the employee spouse go to back to their employer and ask them how much it's going to cost them to come out of their own pocket if they are separate, instead of being on just one plan. Too many times the employee just looks at this plan here at the county and says, I'm going to be with this plan because it's the better contribution. If you have 2 levels of contribution to that person that has a spouse who has a full-time job and has eligible health coverage through that employer, now you're making that spouse go back to the employer, or the family's now coming together and asking them what's best for them. If they come off of your plan, the county's plan, well, the one that saves you premium and it reduces your risk. So as a broker, I'm promoting that to a lot of my clients.
Just follow that up. My concern is, does that open the employer then to a discriminatory accusation that I'm not discriminating against a spouse that works versus a spouse that doesn't?
No, because you're still, that's a good point. If your spouse does not work and she or he does not have eligible coverage through her employer, let's say she's part-time or he's part-time, and they don't have eligible coverage through that employer, you still pay it at 25%. You still contribute at 25%. It's only towards that spouse who has eligible coverage through their employer. And you offer it to them, and they are choosing which is best for them. So as long as the employer is offering both options, you're not discriminating against anyone. The employer that's doing this has seen a lot of success with this. And it takes some wording. We need to put it down in some wording that they understand what that means, because there could be some confusion behind that. But it's certainly a way to help reduce the cost or the contribution level that the county pays.
Ms. Griggs.
From an enrollment standpoint, I have seen that a lot from other employers when we're enrolling. The employees will come in and, ask about our plan, and their spouse's employer is... Basically, I just see that a lot, that the employer is, the spouse's employer is inquiring, and if they're offered, the employee has to take it and whatnot. But there are several different, Bruce is suggesting that idea in regards to doing that. I mean, there are a lot of ideas out there to change, I guess, what we do currently and decrease our costs, for sure.
I think what the committee's, the gist of the committee is, the task is to balance the taxpayer's concern with giving the employees a good plan. So we're trying to walk that line as a committee and make good recommendations back to the full county. I mean, that's our mission. And so, any other questions? Oh, Jim.
Not a question, just a statement. We sat here last year with the rate increase facing us, and we said it's too late to do anything. So that's why we're starting now in April and I'm gonna look at 3 different options or 3 different people with their options. Our renewal isn't what, till December? I mean, if we called personal care right now and said, what would our renewal rate be, it wouldn't be accurate anyway because there's not enough experience down the line, but we just don't want to be sitting here next year at renewal time saying we should have done something, so we're trying to do it ahead of time. So try to keep this stuff in the foremost of your mind, and when we get all done here, maybe we'll have some better options than we had last year when we said it's too late to do anything.
Anyone else? Ms. Griggs?
You guys may know this, but we typically go out to bid the first week of September and start asking companies for their quotes and rates then. So that'll be here before we know it. And you had mentioned about Blue Cross Blue Shield earlier. I know you know this, but just so that the rest of the board is aware, but they don't offer an HMO in this area, and that's really why they haven't been competitive with us as a group the last several years.
Yeah, their alternative to that, not having an HMO, is to offer a low deductible plan. Because even your HMO plan probably has an out-of-pocket expense, even though it may not have a deductible. I would almost guarantee that the employees have an out-of-pocket expense on their HMO plan. So, true blue HMOs, really, the zero deductible, zero out-of-pocket, are pretty uncommon these days.
Has the committee got any other questions? If not, thank you, Bruce.
Thank you.
Okay.
Appreciate it.
Thanks for your help. Yeah. Any information you need to see, it's great.
Thank you.
Next on the agenda is the quarterly update from personal care.
Just to let you know.
Oh, I'm sorry.
Just to let you know, I talked to Audra from Personal Care. They just this week are pulling the reports for January, February, March. So they asked if they may come to next month's meeting so they can give you an accurate presentation. Okay?
We'll get that on the agenda for next month. Thank you, Lynn. Okay, Finance Department, Mr. McCarty. There you go. Morning, Steve.
Morning. Leo said I gotta keep it short, so I'll do my best.
Leo said everything's short.
He said that, Leo.
Steve told me to say it.
You wasn't supposed to tell everybody.
We'll take one of those. Take one of those. We'll take one of those.
As you're receiving your information, we've got just some updates, a continuation of last month's information. We have some year-to-date information for fiscal year 08 and a very rough draft of a projection to show some early trends as compared to where the budget is. Also have some information on levy changes that are that we've talked about, and similar to what we're doing with the health insurance, start now so we can discuss it and have potentially something figured out by the next cycle, and then some insurance renewal information, whatnot. So probably the most asked question that I get, how are we doing? As far as 08, what's 08 look like? What are the revenues doing? Last month I randomly picked some revenues, shows you some up, some down. Yeah, unfortunately, it's still, some of them are still trending down. But as this, the first page, the general fund analysis activity summary package is the first one that we're going to cover. We use the same thing that we looked at last month with the fiscal year 07 draft numbers and plugged in where we're at for 08. So on expense, these are budgeted numbers by department. All right, so it's extremely early to try to trend expenses at this time. So we just looked at it as from a budgetary standpoint, assuming everybody stays within their budget. No contingency used, where we would end up. And as you'll see in the next couple of reports, for the most part, everybody's within that, budgetary area from a cash flow basis. There's an outstanding issue with the corrections retro. Our union contract is not complete yet through the negotiation process, which will require retro back to 12/1 last year, 12/1/06 for all of fiscal year 07, and obviously starting in 08. So that one's going to be a major impact. We don't know the exact amount yet because it's not complete. So as you can see, what's that? So as you can see, we've got some good and some bad. Not bad, but as far as hitting the moving target of the revenue cycle, you can see that the inmate program has definitely picked up from where we were. However, as you can see, as the departments have adjusted and done a great job adjusting, as you can see on the expense numbers from year to year, you can also see that the revenues have also adjusted themselves. So we're still trying to hit that moving target. We haven't quite hit it, balanced it out yet. As the subtotal, showing of the non-grant grant activity there. Showing the totals of the the non-grant grant activity together. So what does this mean if we take the resolution that was passed when we did the inmate program, and basically in putting the money away, the net revenue away to pay down the debt early as possible. That means that we're still $337,000 short, of balancing out. Without the corrections contract and without, we're just talking about health insurance, it's probably the single largest adjustment that happens in the general fund. Last year, the 18% calculated a change in the general fund of $600 and some thousand. So you can see that the potential, overall surplus that's out there potentially could get chewed up quickly, very quickly, and could actually be negative by the time we get to the end of the year, with some of the changes still outstanding. So, at this point, we talked about, have-tos and want-tos, and as far as not filling, positions if they become vacant. I think we're going to have to continue to stress that, and we may still have a potential need to, if we stay on the cycle of keeping the inmate revenue as in and of itself, as we're trying to show here, then we may, for the 09 budget process, be asking the department heads to cut back again with early indications here. So, so we got some good news, we got some not so good news, and obviously how these revenues are kept separate and going forward, obviously they're going to be very important, to the overall picture. Just a reminder, we have a lot of capital needs. The earlier we can get that debt paid down, as was the original plan, the sooner some of the other capital needs may be able to be addressed, if this program continues on past the bond payment cycle, once the bonds are paid off. So, if there's any questions, obviously we'll keep updating this, continue to watch the trends. We'll eventually watch exact trends, as far as in there, some departments, some things happen early in those departments, some things happen late in the year in certain departments. So, that's why I chose to use the actual original budget to just take a look at revenue trends as we can see them now, some early trend information that we have, and then, against against the original budget. Again, this is an accrual, as we talked about accrual and cash. This is on an accrual basis report. The next report, if there's no questions, this report will be a cash report to show where we're at, from an in and an out perspective as of the end of March. So before I do that, I'll entertain any questions before I move on, and we'll go too quick if somebody has any questions.
I think the department heads last year did a good job after the warning bells began to sound there early in the year. And I think what Steve's report is showing that we need to continue that trend. They did a good job, and we're going to ask them to do another job similar to that next year or this year. So with the volatility of some of the income, we need to be wise in the way we run our departments, and the department heads have shown that last year, so we need to continue that.
Any other questions on that?
Any other questions? Anybody comments?
The next page here, and yours are back-to-back here. We try to save as much paper as possible here. You get an updated revenue and expense through March, December through March. And I printed out the last, 3 years just to give, to show the trend, where we're at in 06, where we're at in 07, and where we're at now in 08. And you'd say, if you looked at the total revenues, you'd say, wow, our revenues are up. You really have to take, as far as a cash flow scenario and et cetera, and take the total expenses and then take the difference, which is on the second page of this style of report there, and see that, it is a lot better than we were a year ago. However, we still have ways to go to try to get back to, let's say, an 06 level, as far as using a different year of a comparison. As far as a cash flow issue, it's better, but we're not out of the woods by any means. Last year I believe we borrowed up to interfund borrowed up to $2 million, and obviously we won't hit that, but we're probably still going to have to interfund borrow before the first tax distribution at some level. So things are better, but we're not out of the woods. So we got, again, a mixed bag of, and we need to continue to focus and get the cash flow up, back up to what it used to be. So again, brings the need to, try to hold back where we can, in any way we can in that regard. So this is just a picture of in and out cash flow wise. Again, as far as the ins and outs and the reason, where we get to using that fund balance, and that it's actually, the fund balance from the first page looks really nice there. Those last numbers of high 4 million, maybe even 5 million. But that's not sitting in a bank account. That's always in motion. And you can see that where that is in motion with the, excess, the revenue expenditure difference as far as the cash flow basis, in the second report. So, so we've always asked the department heads during this time to hold back on any large purchases that may be needed, bulk purchases or but have not until we hit the tax distribution. That looks like it'll be July at this point. So, is there any questions on that update report?
Sure. Mr. James.
Thank you. On this page here, I know it's on this original budget, and then you've got the variances on it. Could you explain that to me? This is the first time I've seen one of these.
Okay.
Thank you.
This is the same sequence. You'll get it like your quarterly report and whatnot. What the variance is the difference between the 08 actual and the 08 original budget. So, as you can see, differences in time. The percent remaining would be the percent of the remaining budget available for the rest of the year, per department. Right now, if all things were equal, and they're not sometimes in expenditures through departments, all things being equal, it'd be 66.67% remaining. You know, would be if all things were spent on an exact